What happens when a crypto exchange goes bankrupt? So before we get started, make sure to hit that like button and also subscribe to my channel. What traders hoping to recoup their funds from failed cryptocurrency exchanges anytime soon are likely to end up disappointed, legal experts tell CNBC. Crypto trading and lending firms Celsius and Voyager Digital filed for bankruptcy this month, leaving users' assets trapped inside their platforms. Both firms froze client accounts after an influx of withdrawals led to liquidity issues. Celsius operated much like a bank, taking customer deposits and lending them out or making risky gambles on so-called decentralized finance products to generate high yields. Voyager had a similar model. The company got caught up in the collapse of high-profile crypto hedge fund 𝐥𝐤𝐤𝐤 Capital, which itself went belly up after defaulting on a $660 million loan from Voyager. Such interconnectedness has left the crypto market vulnerable to contagion, with major firms falling like dominoes as a plunge in token prices has unwound excessive leverage in the system. Is my crypto safe? Cryptocurrencies aren't regulated, meaning they don't offer people the same protections they would get with money held in a bank or shares in a brokerage firm. For example, the U.S. Securities Investor Protection Corporation insures traders up to $500,000 in cash and securities if a member broker runs into financial difficulties. The Federal Deposit Insurance Corporation, meanwhile, offers bank depositors protection of up to $250,000 if an insured lender fails. There are similar schemes in place in the UK and European Union. With no laws governing crypto assets, there's no guarantee investors would be able to recoup their funds if an exchange were to freeze someone's account, or, worse yet, completely collapse. There isn't such a scheme like that at this point for crypto, said 𝐥𝐤𝐤𝐞, partner at 𝐦𝐨𝐬𝐤𝐞. It wouldn't surprise me if one happens down the line, he added. This will ramp up calls for enhanced regulation. What happens if an exchange fails? For now, it's still not entirely clear. While there are examples of crypto firms filing for bankruptcy overseas, 𝐦𝐨𝐬𝐤𝐞 in Japan, for example, such an event is unprecedented in the U.S. Creditors of 𝐦𝐨𝐸𝐞, which went offline in 2014, are still waiting to get repaid billions of dollars worth of cryptocurrency. The problem with centralized crypto platforms is they can mix different clients' funds together to make risky bets, according to 𝐦𝐨𝐬𝐤𝐞, a lawyer with 𝐜𝐨𝐬𝐤 and 𝐼𝐚. Such commingling may lead to a ruling that the assets are the property of the exchange, not the users. Users may be surprised to learn that, in a bankruptcy scenario, the crypto and funds held in their accounts may not be considered their own property, 𝐥𝐨𝐬𝐤 says. Exchanges will often pool different customers' crypto and funds together in the same storage wallet or account. What happens to customers' funds in bankruptcy cases will depend a lot on the company's user agreement and how it used its assets, 𝐦𝐨𝐬𝐤 said. Celsius terms of use state that any funds deposited with the firm may not be recoverable in the event of bankruptcy. The firm filed for Chapter 11 protection last week, revealing a $1.2 billion hole in its balance sheet and owing users around $4.7 billion. Celsius claims to have $167 million in cash on hand, but it's still not letting customers withdraw their funds and hasn't offered clarity on when it will reopen withdrawals. Voyager says its customers' dollars are kept in an FDIC-insured account at Metropolitan Commercial Bank in New York. However, this claim was contested by legal experts in the bank itself. The FDIC only offers protection of funds in the event of a bank's failure, not a crypto exchange. For its part, Voyager says it's working through a reconciliation and fraud prevention process with its banking partner, after which users will be able to regain access to their cash. Voyager also laid out a plan to reimburse users with crypto in their accounts, Voyager shares, and the company's own token, as well as any debt recovered from 𝐥𝐤𝐤𝐤𝐿 Capital. Both Celsius and Voyager hired Kirkland & Ellis, the prestigious law firm, to represent them in court. Investors holding crypto assets through Voyager Digital and now Celsius have been placed in a difficult position. With their accounts frozen, Their lawsuits stayed and the value and timing of any recovery is unknown, 𝐦𝐨𝐫𝐞 said. There is a lot of work for them to do in bankruptcy court before these issues will be resolved. Celsius and Voyager filed for what's known as Chapter 11, a form of bankruptcy protection that allows firms to restructure their debts. The aim is to ensure there's still a viable business by the end of the process. There's a strong likelihood that Celsius and Voyager's users will be treated as unsecured creditors, legal experts said, a categorization that puts them in the same bucket as business suppliers and contractors. This means they would likely be at the back of a long queue of creditors lining up for a payout from the court proceedings, behind banks, employees, and tax authorities. In a May regulatory filing, Coinbase said its users would be treated as general unsecured creditors in the event of bankruptcy. In general, most customers in cryptocurrency exchanges are unsecured creditors, so when an exchange collapses, secured creditors are paid back first, along with legal fees, said Dustin Palmer, managing director at consulting firm Berkeley Research Group. Customers will be paid last on a pro rata basis. In a typical bankruptcy, this is pennies on the dollar. Customers will likely have to wait until the full bankruptcy process is complete before receiving remuneration, and bankruptcy usually lasts years, Palmer added. Lehman took years. Some 𝐦𝐨𝐬𝐤𝐞 customers, for example, still haven't received any remuneration. 𝐥𝐤𝐤𝐤 added customer recoveries in bankruptcy proceedings may be further diluted by other unsecured creditors, such as vendors, lessors, and litigation claimants. Cryptocurrency is not FDIC insured. While confusing marketing messages have led investors to believe otherwise, cryptocurrency holdings are never insured by the Federal Deposit Insurance Corp. Investors should know that if their crypto exchange goes out of business, no government agency will make them whole. That's different from a bank, where the government insures funds are up to account and institution limits. The FDIC has gone so far as to require any member banks and financial institutions that engage in any activities related to cryptocurrencies to disclose that activity to the FDIC for supervisory feedback. Stablecoins, a category of cryptocurrency, always pegged to a national government-backed fiat currency, also fall outside FDIC coverage. As holders of the TeraUSD stablecoin experienced, those currency pegs are not always viable. How to recover funds from a bankrupt cryptocurrency company. If you followed Know Your Customer requirements and created your account with legitimate information, the crypto company should have your contact information and an accounting of what you're owed on file. If the company goes bankrupt, you should ideally hear from them right away with information on recovering funds. Most companies will employ their own process to distribute funds to customers. That may require you to follow up by completing forms, confirming your address or payment information, and keeping up with any other necessary paperwork to get your crypto or cash returned. While there's a risk that cryptocurrency investors could get no money or crypto back after bankruptcy, there's also a chance that they will get something back, even if it's just a portion of their original investment. Are cryptocurrencies backed by other assets? Each cryptocurrency is unique and follows its own set of rules and features. Some cryptocurrencies, like stablecoins, have assets backing them, while others don't. How do stablecoins work? Stablecoins are a cryptocurrency asset class designed always to be worth the same amount relative to an underlying asset, like the US dollar, the euro, or physical gold. Asset-backed stablecoins, such as the USD coin and Gemini dollar, issue new currency only when new dollar-backed assets are deposited to the backing account. Algorithmic stablecoins use other methods to maintain the peg value and don't rely on underlying assets for value. The bottom line: a bankruptcy at any financial institution that you work with can be stressful, confusing, and costly. In the cryptocurrency industry, customer confusion and losses can be even worse. But rather than panic, it's best to let the bankruptcy process pan out to determine exactly what you'll get back. If you find yourself involved with a bankrupt crypto company, keep close tabs on your inbox and mailbox for information on how you can file a claim and get as much of your money back as possible. What do you think about our video? Let me know in the comment section below. If you enjoyed this video, make sure hit that like button. Also subscribe our channel before you go. But thank you for watching video.